This question tests the assumptions underlying cost behavior analysis, a fundamental topic in managerial accounting and cost volume profit (CVP) analysis. When classifying costs as fixed or variable, accountants simplify real-world cost behavior by making several assumptions. The key idea is that cost behavior is analyzed within the relevant range, where cost relationships are expected to remain stable. Within this range, total fixed costs remain constant. Variable cost per unit remains constant. Consequently, total costs can be represented by a linear equation. This linear relationship allows managers to prepare budgets, perform CVP analysis, and make planning decisions. The question asks for the typical assumption made when identifying fixed and variable costs. General and administrative costs are assumed to be variable costs. Incorrect. General and administrative expenses are typically fixed or mixed costs, not automatically classified as variable. B. Cost behavior is assumed to be realistic for all levels of activity from zero to maximum capacity. Incorrect. Cost behavior assumptions apply only within the relevant range, not across all possible activity levels. C. Total costs are assumed to be linear when plotted on a graph. Correct. Cost behavior analysis assumes a linear relationship between total cost and activity within the relevant range, making budgeting and forecasting possible. D. The relevant time period is assumed to be 5 years. Incorrect. There is no standard 5-year assumption. The relevant period depends on the purpose of the analysis and business circumstances. Correct answer. C. Total costs are assumed to be linear when plotted on a graph. The standard cost behavior model assumes that fixed and variable costs behave linearly within the relevant range, allowing total costs to be expressed as a straight-line function of activity. This question tests the understanding of mixed, semi-variable costs, which contain both a fixed component and a variable component. Electricity cost is a common example because a company typically pays a fixed service charge plus an additional amount based on actual electricity consumption. The key phrase is both a fixed component and a variable component within the relevant range. Students should remember the following cost behavior principles. Total mixed cost increases as activity increases because the variable portion rises with production. Variable cost per unit remains constant if it varies directly with output. Fixed cost per unit decreases as production increases because the same fixed cost is spread over more units. Consequently, total cost per unit generally declines as production increases, since the reduction in fixed cost per unit outweighs the constant variable cost per unit. The question asks for the incorrect statement, so students should identify the option that contradicts these principles. A. The total electricity cost will increase as production volume increases. Correct. The variable portion increases with production, so total electricity cost rises. B. The total electricity cost per unit of production will increase as production volume increases. Incorrect. As production increases, the fixed cost per unit decreases, while the variable cost per unit remains constant. Therefore, the total cost per unit typically decreases, not increases. C. The variable electricity cost per unit of production will remain constant as production volume increases. Correct. The problem states that the variable component varies directly with production, so the variable cost per unit remains constant. D. The fixed electricity cost per unit of production will decline as production volume increases. Correct. The same total fixed cost is allocated over more units, causing the fixed cost per unit to fall. Correct answer. B. The statement is incorrect because total electricity cost per unit does not increase with higher production. Instead, the spreading of fixed costs over more units causes the cost per unit to decline, assuming operations remain within the relevant range. This question tests the difference between actual costing and normal costing systems, particularly the advantages of normal costing. Students should recognize that actual costing uses actual direct materials, actual direct labor, and actual manufacturing overhead. Since actual overhead costs are often known only at the end of the accounting period, product costing may be delayed. Normal costing uses actual direct materials, actual direct labor, and a predetermined overhead rate based on estimated overhead and estimated activity. This allows overhead to be assigned as production occurs. The question asks for the statement that is not a benefit of normal costing. Therefore, students should identify which option does not represent an advantage of using predetermined overhead rates. Typical benefits of normal costing include more timely costing because overhead can be applied during production, smoother product costs, avoiding month-to-month fluctuations caused by seasonal overhead spending, lower administrative cost and easier application of overhead. However, because overhead is estimated rather than actual, normal costing does not necessarily improve accuracy. In fact, actual costing may be more accurate after all actual costs are known. A. More timely costing of jobs and products. Incorrect. This is a major advantage of normal costing because predetermined overhead rates are available throughout the year. B. A smoothing of product costs throughout the period. Incorrect. Normal costing reduces fluctuations caused by irregular actual overhead costs. C. Improved accuracy of job and product costing. Correct. This is not generally an advantage of normal costing. Since overhead is allocated using estimates, product costs may differ from actual costs and require year-end adjustments. D. A more economical way of attaching overhead to a job or product. Incorrect. Using predetermined rates simplifies overhead allocation and reduces record-keeping costs. Correct answer, C. Improved accuracy of job and product costing. Normal costing improves timeliness, consistency, and efficiency, but because it relies on estimated overhead rates, it does not necessarily provide more accurate job or product costs than an actual costing system.